Good morning, everybody. It's very nice to have a chance to talk to you about something I've been, in some sense, working on only recently, like the last 2 years or so, but in some sense it goes back to more than 20 years of my work. During my PhD, I actually focused on environmental economics, wrote papers on sustainability and tradable permits and even fishing licenses and so on. Then got drawn into the topics of corporate finance and asset pricing. And now, for the last 10 years or so, I've been back in the sustainable finance work. And more recently, although I've focused a lot on climate issues, I've started to work on ecosystems and biodiversity. And this is the first paper that came out of it. It's joined with Zacharias Sautner, who's also here in Zurich, Alexandre Garel and Arthur Romek, who are both in France. So I don't think I need to motivate here in this audience why biodiversity, natural capital, ecosystems are very important. I'm just going to start by saying what the definitions are that we use in our work. And of course, it's a quite heterogeneous topic. So we understand by biodiversity the variety of living organisms, and as economists, we are not per se naturally interested in the biodiversity, but in the services that it provides. So the ecosystem services that come out of it are important. And what are those? I think everybody's aware. If you had an apple this morning, right, that apple does not come from the Coop or the Migros. It grows on a tree originally. And for trees to bear apples, most of them need to be pollinated. Right? There are some that can bear fruit without pollination, but most need pollination, and pollination needs pollinators. And that's an ecosystem service that's being provided by nature. Other services, so food provisioning. If you've ever taken medicine, you've had a benefit of the ingenuity of nature and the ingenuity of pharmacologists to find out inspiration from what nature has to offer for us. Also, if you like to go snorkeling, it's of course nice to have corals, but corals play a very important role in flood mitigation as well, especially the older corals. So these are all services. And the World Economic Forum estimates that around half of world GDP depends very strongly on these ecosystem services. Well, in some sense, of course, everything depends, right? If we have no clean air and no clean water, then everything is gone. But in a more specific sense, it's still, the dependence is very large. It's not 100%, but very, very large. And so many policymakers, central banks, market-oriented researchers have started to worry about what that implies for our world, and especially also what the role of financial markets can be in this space. So, for example, the Network for Greening the Financial System, NGFS, that's a central bank association, they published a framework that are asking banks and supervisors to really look at this, and the talks we've heard this morning already tap into the regulatory dimension. I'm going to jump over this planetary boundary thing because Agnieszka showed it. Anyways, we've had some interesting policy momentum. Right? It's not like the topic of biodiversity loss is new. People have known about it for a while, and whatever statistics you prefer, right? The 70% loss of general loss of species over the last 50 years is one number that's been around a lot, although there's lots of heterogeneity around the world in it. And even in 1992, the Rio Declaration, right? Even that had both climate and biodiversity in it. And so in parallel to the Conference of the Parties of Climate, which have received a lot of attention, there have always been meetings of the Conference of the Parties for biodiversity. It just didn't move along as much. A possible breakthrough has been the Kunming-Montreal Declaration, framework, the Global Biodiversity Framework, Kunming, October 2021. Where really, so Kunming is not a non-binding declaration, and the Montreal Agreement has a little bit more binding grip to it, where really there now seems to be a fresh sense in the air that governments want to do something in this space. But it's a lot of uncertainty what is it that's going to be coming? And that's going to be a central theme from a financial market standpoint. Another perspective is the moves more from the private/public interaction, so the task force on nature-related financial disclosures, also mentioned today already, was launched in June 2021. They put out their final recommendations in 2023, have lots of guidance coming along here. There's one thing I want to point out about it. Yes, there's a parallel to the task force for climate-related financial disclosures, but the game is very different because this time, major players have been part of it from the get-go. So for example, Norges Fund, which is one of the most powerful players in the world in the financial space, owning more than 3% of most companies in the world, gives you a little bit of say about what's happening in the world. They only came on board for the task force for climate-related financial disclosures pretty late. For the task force on nature-related financial disclosures, they actually were a partner from the beginning, and so they've been driving this whole process. Yeah, so there's a sense of fresh hope here in the air, but there's a lot of uncertainty. And now this is where it's going to become a bit more economic. So if that's my perspective on here, although I also have a law degree, but my role here as an economist. We economists, we think about risks in the following way. When a new risk arises, investors might start to worry about this. So for those of you who know this work by Pastor and Veronese, that's kind of the benchmark idea here. When a regulatory risk arises, in general, I'm not even talking only about biodiversity, then those companies that are more exposed to that uncertainty that comes with potential new regulation, they are going to be considered to be worth less by investors, or in other words, investors want a higher risk premium, a higher return from those companies. That's the basic prediction of economics here, that biodiversity risk might have an effect on investors and companies through this channel of creating additional uncertainty about how is the transition going to happen. So that's the transition risk part that this paper is mostly focused on. Okay. The other part, which was also mentioned, physical risk, is also important. This is not what this paper per se is about, though I have a few things to say about it towards the end. But the primary focus here in this focused presentation is to check and see what do the data tell us. This is going to be an empirical analysis of, do investors actually have they started to price some risk in the stock prices of companies that comes from this regulatory move, and which is ultimately driven by the concern for the environment, the concern for biodiversity. Okay, so interestingly, I have a little bit of a cognitive dissonance. On the one hand, there's a huge literature on climate finance. I think I'm not exaggerating when I say thousands of papers out there that study how climate risks are being priced, and what institutional investors do or don't do, how analysts think about it, and so on and so forth. But there's basically nothing on the topic of ecosystem services or biodiversity or natural capital risks. Now, the two are, of course, related. There's a climate biodiversity nexus, but they're not related in a trivial way. They are distinct. The most obvious distinction is one is a global problem. It doesn't matter where we have the carbon emissions. The other is a local problem. It does matter which ecosystem is attacked the most because it has local and ultimately also broader effects. Both are grand risks, but they're very distinct. And it's very curious. For some reason, people have really not worked a whole lot on this biodiversity risk dimension. Well, the reason is pretty clear. It's much harder because measurement is much harder, and I'm going to get to that. So there's a few papers here going on. In fact, the Review of Finance, one of our premier journals in our little academic world of academic finance, right? One of those journals has put out a call for papers, which has received a massive response from researchers. Around 150 proposals were handed in the topic of creating new knowledge in biodiversity in finance. So I think this slide will look very different even 6 months from now, but this is the current stage. Our paper, fortunately, is the first one to get published in a leading journal in finance, so I'm happy to report on our results here. What does one need to test this hypothesis, or to get at the question of, have investors started to price the biodiversity risk now that regulation is on the move? Right? That's the framework I laid out to you, and we need 2 ingredients for that. One is we need a measure on the firm level, not some grand social macro view, but on a specifically firm level, on thousands of companies, of how exposed are they to that risk. And the exposure from that risk, the exposure to regulation, where does that come from? Well, it comes from, at least in the logic of us financial economists, it comes from, well, how big is the negative impact that a firm currently has on biodiversity? Right? Think about it this way: if you're a company that is, I exaggerate now, you're very dirty, right? Then clearly you are more at risk of regulatory, or you're more uncertain about what that regulation means for you. So we need a proxy for how bad is a company in some sense, how negative is their footprint on the world. And this is much different and much more complicated than in the carbon space. In the carbon space, we just look, well, how much CO2 tons do they emit? Maybe we need to work with CO2 equivalents if they also have methane and so on and so forth, but that's not that hard. Biodiversity impact is much more complex, and I'll take you through one case study, one of the thousands of companies that we look at. The second part is going to be linking that to stock price developments. That's easier. That's more on our home turf as financial economists, but even there will be some things that I can only allude to today, which are a little bit tricky in this context. I want to spend most of my time, and I'm mindful of time, I want to spend most of my time talking about this because this has been measured. Metrics and measurement is a key issue, and I just want to convey one perspective in the limited time I have on what data one can use. And of course, there's lots of other things that are happening as we speak. We are using a measure called the Corporate Biodiversity Footprint, which has been developed by a company called Iceberg Data Lab. And the basic idea is that you want to have a measure of how a given company or thousands of companies have an impact on a measure of biodiversity through their global activities. Now, how do you measure biodiversity and how do you measure the impact on biodiversity? There are many measure possibilities. And I actually also presented this to ecosystem services researchers, both at the University of Zurich and UZH, and trying to get as much possible feedback as there is. And although there are more advanced methods, and I'll mention some of them, what I'm using here and what this measure uses is kind of the most widely used. It has many problems, but it's the most widely used. It's called mean species abundance. So the idea is, and I'll do that graphically first and I come back to this. Unfortunately, the figure quality isn't very high, but you can get the message. So if you look on the right scale, for example, in a place where the original pristine situation of grassland is depicted here at the top, this is what would be called 100% mean species abundance. Basically, there's a set of original species living on a plot of land, above, below land. Now, as this gets degraded, in the worst case, intensive agriculture brings us down to 0% mean species abundance. Nothing is living there anymore. Okay, so this measure of MSA, mean species abundance, tries to get a sense of how much, or the change in MSA, how much of the original biodiversity is lost. And there are many tricky things. How do you account for new incoming species? Do you weigh some species more than others, and so on and so forth? This measurement sidesteps all of that. It actually just takes a plain vanilla approach of counting and does not say, okay, some species, some rare species are really important. Even though ecosystem services research says, yeah, that is actually true, but it's very hard to capture that. So I'll give you an example, and I'll do that by the way of Danone. So everybody of you may have had yogurt in the morning, all right, or something that Danone produces, most likely. Danone makes 20 billion revenues, 20 billion euros revenues, or Danone, as it's called in the United States. Has 20 billion revenues approximately. We have the computation for 2021 here. About 2 billion of revenue of that comes from dairies and cheese operations in the United States. Okay, so one breakdown here is by operations. I know what is it that the product is, and the other is where is it happening. To get to 2 billion euros of milk products, you need a raw input, milk. You need approximately, according to the disclosures of Danone, they actually disclose a fair amount, they needed about 2 million tons of fresh cow milk. Okay? Now, they don't have cows themselves, right? They buy that milk from somebody else. So now we are talking in the spirit of climate terminology, we are talking about the scopes of activities. Here we are also looking at the scope 3, the sourcing of materials, not only the direct impact. So they get cow milk. Cow milk is a commodity. In this model, there are thousands of commodities. Sugar would be another commodity, copper would be another commodity, and so on and so forth. Each commodity exerts, if you want to extract it, a certain environmental pressure. So to get to 1,000 tons of cow milk, according to estimates that have been done by agricultural researchers, you need approximately 13 square kilometers of land. And according to estimates of ecosystem services researchers and implemented in the so-called Globio model, that plot of land of 13 square kilometers will be degraded from an MSA of 65% on average to an MSA of 60% of average. I'm just throwing out these terminologies and numbers at you to illustrate that for each activity, the name of the game here is to think through each activity of a company and think about what is the environmental pressure that this activity exerts. And now, of course, one does that not one by one in a big spreadsheet, but one has a huge matrix of around 2,000 commodities, around 200 sectors where those commodities are being used, and data that has been collected over decades from different places in the world, how much in particular cases we have been observing that the impact of humans has had an impact on mean species abundance in that place. And that is sort of then averaged and applied also where we don't actually observe the data. That's the best one can do. One does not observe in real time what is happening with biodiversity. One takes the experience over 50 years of measurement and applies it to all these activities of a company. At the end of the day, for example, as you might imagine, for a company like Danone, where they use a lot of land, land use is the most important component of biodiversity impact. But they have other impacts as well. For example, there's carbon emissions that happen, there's water use, pollutants, and so on and so forth. At the end of the day, and I don't have the time to go into more details here, but at the end of the day, the aggregation of all those activities across commodities, across sectors, across countries where Danone is active, leads to a total estimate of the impact of Danone on mean species abundance in this quantity. We are all now used to seeing CO2 parts per million as a quantity of interest. You know, I consider it possible that in a few years everybody is used to seeing quantities like these, changes of biodiversity. It may not be MSA in the end, maybe STAR, maybe PDF, one of the other measures. But this is one of them. So this quantity here means, in words, that the impact of Danone in a given year is equivalent to bringing down biodiversity from the pristine state, wherever it was, to 10% less in an area of around 100,000 square kilometers. It scales. Or it goes from pristine to nothing in a space of 10,000 square kilometers. Now, let's be careful about the interpretation here. Maybe I should do a quick test. How big is Switzerland? How many square kilometers? 40,000 square kilometers, pretty close. Excellent. So this does not mean that Danone destroys a quarter of Switzerland every year. It's just the continued pressure that is there from their activities, because they don't, it's not, I'm not pinpointing them or making them naughty players. They actually did disclose a whole lot here. It's not the additional destruction, but it's the continued pressure that comes from agricultural activities, right? Not being allowing to let the land regrow. Okay. Of course, you can say, well, the actual footprint is on us because we consume the yogurt, right? But here the space is corporate biodiversity footprint. Importantly, a lot of this comes from the scope 3, so the value chain, not the direct activity of the company. If you're interested, you can look at the paper. I just brought this slide. We don't have time to go through this. There's lots of drawbacks of this measure of MSA. There's alternatives, but really none of them at this point, on September 12th of 2024, is implementable, at least to my knowledge, on this grand scale of thousands of companies over several years. So that's a drawback. You can say, well, maybe no number is better than some number if the number is so bad. But at least here we have some estimate that is reliable, where we know where it comes from, and that's worth a lot. To give you a bit of a sense, let me just see. So on average, most of the CBF, the corporate biodiversity footprint, comes from scope 3, so from these links to other companies. Land use is very important. Greenhouse gases obviously play a big role. Global warming has a negative effect on biodiversity. Anticipating an important consideration for the empirical analysis, we can take out that effect, the pure global warming effect, from the estimates that we get for the risk premium that investors require. Right? So it's possible that investors just if they require risk premium from biodiversity impactful companies, then it's possible that that's because they worry about climate change. But we can actually take out that effect and look at only the rest, which has nothing to do with climate change. So we can orthogonalize those effects. It's also very important, I don't think I have that with me here. It's just one line. There's a lot of firm-specific variation. So policymakers tend to work with industry averages, but if you actually look at this, more than half of the variation in the footprint of companies is firm-specific. So using things like the Encore database, that's at best a start, but it actually doesn't get at the variation among companies in a great way. That's different than in the carbon space, for example. So I'm not, by the way, I'm not making any money out of this particular measure that's being used here, the corporate biodiversity footprint, but it is interesting that a large number of investors are using this now. Right? So this is not the purely academic exercise anymore. So BNP Paribas, Mirova, these are not small players. They are using exactly this measure that I've described to you to think about the portfolio footprint overall. They're mostly interested in portfolios. Okay, so it's coming. There are other measures, and I'm sure Rolf Weber in his talk at the beginning said in the last sentence, well, The FINRA circular has the nice side benefit that it creates jobs for lawyers, right? The same, in some sense, is true of data, right? If you have a good idea for coming up with biodiversity data these days, it's a pretty good business to be in. All right, so let me, as I said, I wanted to spend most time on the measurement and now give you 2 minutes of results. What do we see in the data? For those of you in the know, it's, stock returns are influenced by many things and there are many complications, but I'm just going to give you the punchline of what we think is happening in the data, and we can question, of course, all of that. It's still early work. We do 2 things. On the one hand, we look at longer run stock returns. Long run in this case meaning 4 years of data, because there's no more data going back for the footprint. And the other is reactions of stock prices right around relevant events, in particular the passage of the Kunming Declaration. And actually, let me start with the latter one, the Kunming Declaration. So this is as clean as it gets. It looks messy at first, but it's as clean as it gets for an academic event study. So the Kunming Declaration in October 2021 was a surprise. Everybody knew that people are meeting in Kunming, but everybody thought nothing is going to come of that. People were already leaving, then they came back. Up until the last minute, it was uncertain. And then bang, in the middle of the night, there was the announcement, there is an agreement, which was a big surprise. And what we see is that right after, so this is the event day, properly taking into account trading times when actually stock markets were open in the respective parts of the world. What this says here, this big blue drop here, says that right around the day of the event and a little bit after, stocks with a large biodiversity footprint got hammered in the market. So their stock prices dropped. They dropped on average, as it says here, about 1.14% over 3 days. Accounting for many other aspects, that's actually a big drop relative to what other events do. So it seems that the market started pricing this in the sense of assigning lower value to companies with a large biodiversity footprint. For worries, perhaps having to do with, these companies are going to have a harder time in the future because of regulatory reasons. Now, interestingly, the other thing that happened is after Kunming, these stocks started delivering larger stock returns. Okay, so they didn't stay depressed, but it was like this. They came like, then drop, and then a steeper increase afterwards. What does that do? I'm just trying to put myself in your position, especially the lawyers who may not have to do with these logic every day in and out. A larger return for dirty stocks, if I put it that way, at first seems a little bit strange, right? I mean, aren't these the bad guys? Why are they getting big returns? Well, it's fully consistent with the idea that these stocks carry larger risks, and investors want compensation for that risk. In some sense, it's good news that they had to earn bigger returns, because it means that investors were only willing to hold those stocks if they actually made those bigger returns. So I just, knowing full well we don't have the time to go into all the detail here, but what you see here at the top, I think the pointer doesn't quite work, it doesn't matter. So it says monthly return. So we have about 48 months of data, 4 years. Over the whole period, so pre-Kunming, post-Kunming combined, there's nothing. You see a 0.003 coefficient controlling for all kinds of other things. Nothing happens in the sense that overall investors didn't care about biodiversity. And they didn't care before Kunming, but in the post-Kunming period, you see a positive coefficient here. Not knowing the quantities that are underlying, you may not be able to interpret this. That's why I brought the immediate interpretation here. Everything else equal, a company that had a larger footprint by 1 standard deviation compared to a peer actually experienced higher returns by about 2% a year. So that's a sizable increase in the return And as we show in the paper in more excruciating detail, actually it's very likely that this is actually a risk premium and not just a fluke of the data. But that's for the connoisseurs among you, that there's an extra test one needs to do here. But the punchline is, around Kunming, investors started to wake up to the issue of biodiversity risk and have begun to price it in a way that they see companies with a large footprint as more risky. And all of that holds controlling for carbon emissions and many, many other things that might also be going on, but that's the major punchline. Okay, so let me just summarize. I'm not saying that climate we should ignore climate, but certainly we should not ignore biodiversity as one of the major crises of our times. And there are also potential tensions, right? The obvious one being electric vehicles may be good in the sense of they have low carbon emissions, but they still need electricity, by the way. But they, when they run, they have low carbon emissions. But you need rare earths and lithium and so on to get batteries. And these are typically in places where the biodiversity is the richest in the world. So that's a major conflict of climate and biodiversity handling. Our data suggests that biodiversity transition risks have started to emerge. And we hope that this is relevant for macro models, for policymakers, for lawmakers in thinking about what the consequences are, also for standard setters. I had a chance to present this also to the International Sustainability Standards Board, and as you know, they are working on a requirement in the space of nature-related risks as well. And we also hope, to the extent that some of you are actually having management roles, it's actually very important for managers to know their own company's biodiversity footprint, because this risk seems to be real. It's also real for financial institutions. Financial institutions, on average, have one of the largest biodiversity footprints because they finance and invest in companies that have such footprints. And so they're massively affected by the regulation that's coming. Thanks very much.